If you are still sitting in the same portfolio you built for the last cycle, I want to be very direct with you. You are not diversified, you are time-stamped, you are carrying the assumptions of a world that is already leaving the room. Most people do not lose serious money because they are reckless. They lose it because they confuse a long tailwind with personal brilliance. They mistake a rising tide for a permanent law of nature. They think the machine that rewarded them for the last 15 years is the machine they will retire on. That is how decent, careful, intelligent people wake up 5 years older, 10 years angrier, and far poorer than they ever thought possible. I have spent a lifetime buying productive assets, studying human behavior, and waiting for moments when the difference between price and value was wide enough to matter. I am not in the business of theatrical panic. Panic is expensive, but denial is worse. Denial is how a man works for 40 years, does a good job, builds a respectable account, and then hands a third of it back because he refused to admit that the environment had changed. What concerns me now is not 1 quarter of earnings. It is not one election. It is not one headline out of Washington. It is the structural fact that the financial house most people are living in was built for sunshine, and the weather has turned. That is the whole story. People keep asking which stock to buy, which dip to buy, which sector will bounce first. Those are secondary questions. The primary question is whether the structure protecting your savings was built for calm water or for a storm. If it was built for calm water, the next real drawdown will not merely scare you, it will expose you. I want to give you a framework I believe matters, now more than it has in years. Think about your portfolio the way a sensible farmer thinks about a storm shelter. In a mild season, a shelter feels boring. In a decade of cheap money, even foolishness can look efficient. You do not get praised for owning dry powder. You do not get invited to dinner parties because you shorten duration. Nobody admires the man who quietly refused to overpay for speculation while everyone else was getting rich in public. But when the wind changes, the only question that matters is whether your shelter was real. The shelter most investors built over the last cycle had 3 rotten beams in it. The first beam was the cheap money mirage, the second was the duration trap, the third was the fantasy multiple. Put those 3 together and you had a portfolio that could look conservative on paper while being astonishingly fragile in reality. Let me explain what I mean. After the financial crisis, the United States chose the easiest short-term medicine available. Rates were pushed down towards zero. Liquidity flooded the system. Bonds were purchased in size. The cost of money was suppressed so thoroughly and for so long that an entire generation of investors began to treat abnormal conditions as normal conditions. They forgot that money has a price. They forgot that when money is nearly free, almost every asset can look intelligent at the same time. That was the cheap money mirage. Stocks rose because the discount rate was low. Bonds rose because yields fell. Real estate rose because financing was easy. Private assets rose because capital was abundant and patience was unnecessary. Venture speculation rose because when capital is cheap, the future gets overvalued and the present gets ignored. Investors started to believe that the right answer to almost any problem was to own more duration, pay a little more, reach a little further, and trust that the central bank would eventually come to the rescue if things got uncomfortable. That kind of world trains bad habits very efficiently. It trains people to think valuation is optional. It trains people to think leverage is manageable. It trains people to think that if an asset worked for 15 years, it must be safe. It trains retirement savers to own exposures they do not understand because their statements kept going up anyway. Now that world is ending, and a lot of people are still behaving as if it is merely taking a break. The country is carrying over $35 trillion of debt. The annual interest bill has crossed $1 trillion. That is not a footnote. That is a structural fact. When the interest expense on old borrowing starts to rival the size of the largest lines in the federal budget, you are no longer dealing with a normal cyclical issue. You are dealing with arithmetic that eventually corners policymakers. I call that the debt pressure chamber. Most people think debt becomes dangerous only when somebody stops paying it. That is a childish view of the matter. Debt becomes dangerous long before default. It becomes dangerous when it changes the range of political choices. It becomes dangerous when every path forward carries pain. Spend less, and the economy feels it. Tax more, and growth feels it. Inflate the currency, and savers feel it. Monetize indirectly, and holders of long duration paper feel it. There is no elegant exit from reckless arithmetic. There are only different methods of spreading the discomfort. When I see debt at that scale alongside an aging population, enormous entitlement commitments, and a political class that prefers postponement to discipline, I do not conclude that everything will be fine because America is still powerful. I conclude that the temptation to solve a real burden with a weaker dollar will remain permanently on the table. That matters because it leads directly to the first kind of protection serious people ought to understand. But before I get there, there is another vice tightening around this system. Tariffs, supply frictions, and refinancing pressure are arriving at the same time. That is what makes this period uniquely awkward. If you want a tidy boom, bust recession with one clear policy answer, you are likely to be disappointed. What we are drifting toward looks far more like a tightening box. Costs can rise even while growth slows. Consumers can be squeezed even while policymakers are afraid to ease aggressively. Commercial real estate can wobble while rates stay painfully high for old loans, rolling into new reality. Regional lenders can face strain while the broad market still speaks the language of optimism. I call this the stagflation vice. A vice is not dramatic at first, it is mechanical. It tightens slowly enough that people keep hoping relief will arrive before damage does. Then one day they realize both sides are pressing at once. That is the shape of the problem. Now, if inflation pressure reaccelerates, the central bank cannot behave as freely as people wish it could. If growth weakens, the economy still feels pain. If policymakers choose to protect activity too quickly, they risk undermining the currency and reigniting the very inflation they claim to be fighting. If they stay tighter for longer, they pressure the debt system, the refinancing system, and the valuation system all at once. A man does not need to know the exact month of the accident to understand that the road is getting slick. This is where the identity flip has to happen. For most of the last cycle, investors were rewarded for being reachers. They reached for more duration, more growth, more future, more story, more hope. They thought like climbers chasing altitude in the next phase. The people who preserve and build wealth will think like engineers protecting structure. They will stop asking which asset is exciting and start asking which beam still holds under stress. They will stop admiring speed and start admiring resilience. If you are still in the accumulation years and have a long runway, you can survive mistakes that a retired person cannot. That difference is one of the most important truths in finance and one of the least respected. A young worker facing a 40% drawdown can keep contributing. He can buy more shares at lower prices. He can wait. A retiree drawing on the same portfolio is in a different mathematical universe. He is not merely watching a paper loss. He is often liquidating into weakness to fund real life. That is how temporary declines become permanent damage. I call that retirement asymmetry. Most Wall Street marketing material is written as if every investor were permanently 35 years old and blessed with an unlimited paycheck. Real life is not like that. Sequence matters, timing matters, cash flow matters. When withdrawals start, fragility matters a great deal more than theory. So if you are nearing retirement or already living on your capital, your first job is not maximizing upside. Your first job is not allowing a major drawdown to force the sale of good assets at bad prices. That means you need a real shelter, not a slogan. The first chamber in that shelter is gold and hard monetary insurance. Now let me say something that will annoy both the zealots and the cynics. Gold is not magic and it is not useless. It is not a religion and it is not a relic. Gold is best understood as monetary insurance against fiscal indiscipline and currency erosion. That is a very different statement from saying it is a lottery ticket or a doomsday cult object. It is insurance. Most people describe gold lazily as an inflation hedge. That is a half-truth. The more important point is that gold tends to matter when confidence in the discipline of paper promises starts eroding. If a government can solve too many of its long-run problems only by tolerating a weaker currency, then an asset that no legislature can print becomes worth understanding. Gold does not need an eloquent chief executive. It does not miss guidance. It does not depend on quarterly sentiment. It simply sits outside the political temptation to create more units of itself. That is why I pay attention to it when debt loads become absurd and when governments behave as if the value of money were a policy variable to be massaged rather than a standard to be respected. The logic is simple. If the real burden of debt is too large to reduce honestly, then one of the quiet ways governments escape is by allowing the currency to lose purchasing power over time. That process destroys savers who cling only to cash and long nominal paper. Gold priced in those same dollars tends to reflect the debasement long before the average household can explain what changed. You do not buy that kind of insurance because you expect fireworks every week. You buy it because once you need it, it is usually too late to build it properly. There are several sensible ways to own that insurance. Physical gold is the purest form because there is no counterparty attached to it, but it has storage and handling complications. For many investors, a straightforward low-cost gold vehicle is more practical. If a person wants leverage to the metal, miners can provide it, though he must understand that mining businesses carry operating risk, political risk, and managerial risk that the metal itself does not. I prefer people to understand the distinction before they find out the hard way. What matters most is not the wrapper, but the roll. Gold should sit in a portfolio as a monetary stabilizer, not as a source of thrills. I do not believe in putting all my faith in one answer, but I have no trouble understanding why a meaningful allocation, something strong enough to matter, but not so large it dominates the whole structure, belongs in a world where currency management is becoming more political and less disciplined. The second chamber in the shelter is where most supposedly conservative investors are making their biggest mistake. They think bonds are safe. That sentence, stated without qualification, has probably destroyed more quiet retirement capital in recent years than most investors realize. Bonds are not one thing. They are a family of contracts with very different behaviors. A 3-month Treasury bill is not the same animal as a 30-year bond. Treating them as interchangeable is like saying all dogs are the same because they have 4 legs. For 40 years, investors were trained by a favorable backdrop. Rates generally fell. That meant long. Duration bonds could provide both income and price appreciation. A generation of planners built an entire retirement culture on that memory. Shift more into bonds as you age. They said reduce volatility, they said, and during a falling rate supercycle, there was truth in that advice. But when inflation rises and rates move up, long bonds can behave like a trap laid inside the language of safety. I call it the duration trap. A long bond is a promise stretched far into the future. The longer the promise, the more violently its price reacts when the discount rate changes. A 30-year Treasury can lose a startling amount of value when yields rise. That is not theory. It is just math. Yet many people still own piles of long nominal paper under the comforting label of conservative allocation. There is nothing conservative about owning a highly rate-sensitive instrument in an environment where fiscal pressure, inflation pressure, and policy uncertainty are all high. If you must hold fixed income, shorten the promise. That is the rule. Short duration Treasury bills give you something precious: optionality. They mature quickly. If rates rise further, you reinvest at better yields. If the environment changes, you are not locked into a long promise made under the wrong assumptions. Right now, earning a respectable yield in very short government paper, while preserving flexibility, is not glamorous. But glamour is not the goal. Survival with purchasing power is the goal. Then there are Treasury inflation protected securities. They are imperfect, but they are at least designed for the environment many people are pretending cannot arrive. When inflation rises, the principle adjusts. In a world where price pressure may stay stubborn while growth disappoints, that matters. A lot of investors are still anchored to the old religion of the 60-40 portfolio, as if time itself had promised to preserve the relationship. Time promised no such thing. Regimes change. You must change with them. If you are near or in retirement, I want to be especially clear. One of the smartest quiet moves you can make is to stop confusing long duration nominal bonds with peace of mind. Peace of mind comes from knowing you will not be forced into large mark-to-market losses in the supposedly safe sleeve of your account. Short paper gives you breathing room. Tips give you some inflation adjustment. Long nominal duration gives you hope. Hope is not a fixed income strategy. The third chamber in the shelter is where real growth can still live, even while the wider market stumbles. That chamber is businesses with genuine pricing power in essential fields. This is where my own instincts have always been strongest. I like owning businesses that can raise prices without begging permission from customers. I like businesses whose products are needed, repeated, and habit forming. I like businesses with low replacement risk, rational capital use, and economics sturdy enough to endure a difficult decade, not just a pretty quarter. Pricing power is one of the most valuable words in business when costs rise. A business without pricing power gets squeezed. It pays more for labor, transport, ingredients, energy, and financing, but it cannot pass enough of that through. Its margins narrow, its earnings weaken, its investors discover that what looked like growth was really just favorable weather. A business with pricing power behaves differently. It can charge more because its product is necessary. its brand is trusted, its distribution is entrenched, or its alternatives are weak in inflationary or disorderly periods, that difference becomes enormous. I call that the pricing power fortress. Healthcare is an obvious example. Demand there is not optional in the way restaurant meals or luxury gadgets are optional. An aging population does not negotiate with demographics, prescriptions, procedures, devices, and necessary care do not vanish because the market is in a bad mood. Essential healthcare businesses with durable positions possess a kind of embedded resilience that excites me far more than a fashionable software story priced for perfection. Energy is another area worth understanding. If global friction, tariffs, or supply chain interruptions raise the effective scarcity of domestic production, well-run energy businesses can see margins expand rapidly. When the product itself is more valuable and the supply is constrained, the economics change fast. One must still be selective. But the category deserves attention because it lives on the right side of scarcity. Consumer staples remain a classic refuge for a reason. People postpone vacations before they postpone toothpaste. They cut luxuries before they stop feeding their families. The giant every day. Product businesses may never look glamorous, but they often possess what matters most when the economy gets awkward: repeat demand, broad distribution, and enough brand or scale power to move prices without losing the whole customer base. In contrast, I would be very careful with highly speculative growth businesses whose valuation still depends on a cheap money future returning in full. When you buy a stock at an extravagant multiple of present earnings, or worse, at an extravagant multiple of earnings someone hopes will arrive years from now, you are making a very specific macro bet, even if you do not realize it. You are betting that capital will stay forgiving, that rates will stay friendly, that future cash flows deserve rich present prices, and that the market will continue paying up for distant possibility. That is precisely the kind of assumption that thrives in a zero-rate fantasy and suffers in a stubbornly inflationary world. I have no issue with technology itself. I have always had an issue with paying absurd prices for certainty that does not exist. In the kind of regime we are entering, real earnings matter more than narratives, dividends matter more than slogans, balance sheet strength matters more than charisma. The market will rediscover this eventually. My preference is to notice it before the rediscovery becomes obvious and expensive. So if I were rebuilding a retirement-minded portfolio for this new climate, I would not think in terms of chasing the hottest thing. I would think in terms of a 3-chamber shelter. I would want one chamber dedicated to monetary insurance. That is where gold and other hard asset exposure live. I would want one chamber dedicated to short duration safety and inflation, aware liquidity. That is where treasury bills and sensible inflation-protected instruments live. I would want one chamber dedicated to productive businesses with durable pricing power in essential sectors. That is where carefully chosen healthcare, energy, and staples exposure lies. You will notice something about that structure. It is not designed to impress strangers. It is designed to keep you from becoming a forced seller. That is the point. Now, I want to push this one step further because simply knowing the categories is not enough. You need an operating system. You need a protocol you can actually execute. Here is the protocol I would hand to a serious person. First, separate your money into function, not merely into ticker symbols. Some money is there to fund spending over the next 1 to 3 years. That money has no business auditioning for heroics. It belongs in short, liquid, high-quality paper. Some money is there to defend purchasing power against policy abuse. That money belongs in hard monetary insurance. Some money is there to keep growing through ownership of productive businesses that can survive a difficult environment. That money belongs in companies and sectors with pricing power and sober valuations. Second, take a hard knife to duration and fantasy. If you own long-term nominal bonds simply because someone once told you they were safe, revisit that assumption now. If you own richly valued speculative growth because it made you feel smart in the last cycle, revisit that assumption now too. The market does not award loyalty points for clinging to old winners under new conditions. Third, lower your break, even stress. A portfolio becomes fragile when the owner needs too much from it at exactly the wrong time. If you are within retirement range, having enough liquid short, duration capital to avoid selling productive assets during a drawdown is more valuable than another percentage point of hoped. For upside, fourth, define what would make you wrong. Protection without discipline can become dogma. if inflation collapses, if fiscal discipline returns in a meaningful way, if long rates settle for sound reasons instead of coercive ones, then some of today's defenses become less urgent. That is fine. Good investing requires adaptation, not ideology. Fifth, understand that the goal is not to hide from all risk. The goal is to reject unrewarded risk. There is a difference between owning productive assets in difficult times and owning fragile assumptions because they worked last time. A man who cannot distinguish those two things will spend his life calling speculation conviction. I have seen people make a lot of money and still never become secure. I have also seen people who were never flashy build lives of extraordinary strength because they understood a simple truth. The first rule of compounding is not brilliance. It is staying in the game with your capital and your judgment intact. That is why this period matters so much. If you are still 35 and earning heavily, you have time to recover from an error. That does not make errors harmless, but it makes them survivable. If you are 65 and drawing on the capital, the same error can permanently redraw the rest of your life. That is why old playbooks become dangerous when they are repeated mechanically. The great financial mistake of the next few years will not be that people failed to hear the warnings. It will be that they heard them, nodded politely, and kept the same exposures because change felt emotionally inconvenient. That is how permanent losses are born. You do not need drama. You do not need all or nothing. You do not need to predict the day the market finally gives up the story it has been telling itself. You need to stop pretending that a portfolio designed for free money, falling rates, and expanding multiples is automatically fit for debt stress, stubborn inflation, tariffs, refinancing pressure, and political temptation. It is not. That recognition is not pessimism. It is adulthood. I want to leave you with one final distinction because I think it matters more than almost any chart you will see this year. A lot of people think wealth means lifestyle. I do not. Wealth means options. Wealth means time. Wealth means not being pushed into bad decisions by short-term pressure. Wealth means being able to look at a panic market without sharing its panic because you are not cornered. That is what this whole shelter is for. Gold protects the measuring stick. Short-duration liquidity protects the timetable. Pricing power businesses protect the engine. Put those together and you have something very few people will possess. If the next phase gets ugly, the ability to think clearly while others are reacting, that clarity is worth a fortune, and it does not arrive by accident. It arrives because you made a choice early, before the crowd called it obvious. To rebuild your financial house for weather instead of applause, most people will wait for certainty. By then the prices will be worse, the headlines louder, and the options narrower. I would rather be early and sane than late and sorry. So here is the real choice in front of you. You can keep living inside a portfolio built for a world of zero rates, obedient inflation, and endless multiple expansion, and hope that old tide comes back before your capital is forced into retreat. Or you can accept that the regime has changed, rebuild your shelter now, and become the kind of investor who does not need the weather to be kind in order to survive and grow. One of those choices is easier today. The other will feel much better 5 years from now. If I were you, I would make the harder, better choice while I still had the luxury of making it calmly.